Hey, welcome. Good afternoon. Welcome to this month's Employee Benefits Compliance webinar. As we kick off here today, as we often do, you will see a poll launch on your screen. We actually have two polling questions for you here this month. We know many of you are kind of going through your annual benefits enrollment and just recently kind of reviewed your benefits packages. And we are curious, if you added new benefits for 2026, which area or areas were most impacted? You'll see several options there. And also, if you didn't add any new benefits for 2026, you can let us know that as well. And please be sure to scroll down as well. We're also curious if you removed or reduced any benefits for 2026. What was the main reason why? Certainly, we understand there may be multiple reasons, but pick kind of that top reason. Thank you in advance for sharing your perspectives on those polls. And as you are submitting your responses, I'll go over a couple of other items. Again, welcome to today's webinar. I am Jenny Bedeau with AssureXglobal. Today, the Loomlight team will be discussing HRA types and comparisons, and we will get to that content in just a moment. And as we're getting started here, we would also like to extend a special thank you to your local insurance benefits advisors and consultants who are partners of AssureXglobal for making today's webinar possible. And we do welcome your questions today. So if you have questions at any time throughout the presentation, you can submit those over to us by using that Q&A function down at the bottom of your screen. We will address as many of them as we can throughout our time here today. And if you've just joined us, you'll see a couple polling questions up on your screen. Please take a moment and provide your responses to those if you can. And we do often get asked if we record these webinars. The answer is yes, we do record these sessions. A link to the recording, as well as a copy of the presentation slides, will be available early next week from the benefits advisor who invited you here today. I will also drop a link to the presentation slides in our chat section here in just a couple of minutes. And I will leave the poll up here. It looks like responses are still coming in. I'll leave this poll up for just a couple of seconds. And again, I think many of you come to a lot of these webinars. You probably know that we publish the results of these polls every single month into a publication that we call a market check survey. So not only will I share the results of the poll out with you here in just a moment, so you can get a quick peek at those, but via that market check survey, we'll actually do a more formal kind of write-up and analysis of those poll responses, so you can see how other employers are thinking about or reacting to that particular month's polling topic or question. So again, thank you for providing those responses. So let's close out this poll or these polls, and I will share these results out with you. It looks like a lot of folks, 60-ish% are not adding new benefits. I think that's probably not surprising to many of us, given kind of the cost pressures happening this time of year. Particularly, I think probably many of you had to absorb some pretty tough medical renewals. But for those of you making changes, looks like kind of a variety, but most of you kind of in that health and well-being bucket. So thank you for those responses. And actually, the exact same percentage, most of you did not remove or reduce benefits, but for those of you that did, again, probably not a surprise, cost containment was that number one reason. So again, thank you for providing those responses. But with that, let's get into our content today. Joining us from the Loomlight team, we have Regan Devin, who is Director of Compliance Consulting, and we have Dan Brady, who is Senior Compliance Consultant. So team, I will turn things over to you.
Thanks, Jenny. Good afternoon, everyone. And we're really going to go through kind of an overview of HRAs today, talk about all kinds of different flavors. I think very much tied into what Jenny just asked about in the polling. We're just seeing more and more growth around these and utilizing different options that may be available as an HRA to either add on to what you're offering as far as your benefits package, or to perhaps shift things, carve things out of the medical plan, run them through an HRA instead, that type of thing, depending on what you're trying to accomplish and what your employees really need, kind of the best fit. And so what we want to do today is give an overview of health reimbursement arrangements themselves, HRAs. And then I have listed here on the side the different types of HRAs. that Dan and I are going to take turns going through. I'm going to kind of go through a little bit of an overview in the standard HRAs first, and then I'll turn it over to you, Dan, later to go through the rest. And as Jenny mentioned, as we're going through today, we are happy to entertain kind of comments that you have as we go through, or questions that you have, and we'll try and get to as many of those as we can. So just an overview. Set the stage here. HRAs, what are they? What does that mean? They provide tax-favored reimbursement specifically for qualifying medical expenses, and they are fully funded by the employer. So lots of the other benefits that you're providing are a mix of employee and employer contributions potentially. HRAs are specifically accounts that are funded only by the employer and then are used by employees and their family members to reimburse qualifying medical expenses. That's the broad definition. And then we have all these different types. We have the standard HRA that many of us have known about and potentially used for a long time, that are often integrated with our group medical plan. In fact, after the ACA came into play, it was required to be integrated with your group medical plan, and helps to pay for cost sharing potentially under the group medical plan, or maybe even things that aren't covered under the medical plan or are capped under the medical plan. So we'll talk about those and some different flavors of standard HRAs and the way that they work. Then we'll talk about HRAs that are limited in purpose, and they're available solely for dental and vision. We can do that with a health FSA. I know a lot of you probably offer an option between a general purpose health FSA and a limited purpose health FSA, so you're used to that concept, and we've got the same thing for HRAs as well. There also is a new kind of accepted benefit HRA that was just added about 5 years ago now. Both the accepted benefit HRA and ICHRA, the individual coverage HRA, those are two kind of brand new flavors of HRAs that are available. The accepted benefit HRA is capped kind of on how much you can fund in there, but it doesn't have to be integrated with the employer's group medical plan. So it's just a little bit different flavor of something that you could offer. The individual coverage HRA is interesting in that it can be paired along with individual coverage or Medicare and provide reimbursement for those types of premiums in addition to other qualifying medical expense reimbursement, but it can't be offered alongside a traditional group medical plan. So that's really for employers who are choosing to offer reimbursement for individual plans or Medicare instead of offering the traditional group medical plan. So we'll talk about that and where that might be a good fit. We will also touch on just briefly the qualified small employer HRA. That's been around a little bit longer than the accepted benefit HRA or the individual coverage HRA. There isn't a lot of use of that qualified small employer HRA. We don't see a lot of that, primarily because two things have to be true. It has to be an employer with less than 50 employees total, so it can only be offered by pretty small employers. It also can't be offered by the employer if the employer offers a traditional group medical plan. Can't even use different categories and like we can with the ICHRA. The qualified small employer HRA is only available to those very small employers who don't offer a traditional group medical plan at all. And then, of course, the retiree HRA, we want to touch on that one. Quite a while ago, it was just very common that employers offered some type of a retiree coverage for all of their retirees, or at least certain retirees, after they terminated from employment and retired. And that really kind of phased out over time, and we saw less and less employers offering any type of retiree coverage, especially a retiree coverage medical plan. But we're starting to see more and more employers look at ways to make some type of benefit available beyond retiring. And so one of the ways that they can do that, of course, is to put those retiree medical plans back in place. But there are other options. And one that's kind of interesting is the retiree HRA. It's a little bit safer way for employers to go back that direction, where they can really say, hey, this is kind of the max of what we're willing to spend, and then cap their liability while still being able to provide that benefit beyond retirement. So we'll touch on that and the different rules around that as well. As we go through the different types of HRAs, I want to talk about kind of two different buckets where all of those different types that I was just talking about are similar and follow the same rules, and where they're different. And then that's really what Dan and I are going to focus on as we go through the different types, just kind of pointing out those differences to make sure that you understand where they may or may not be a good fit for you, depending on your employer size, who you're wanting to offer it to, what types of things you're wanting to reimburse. All of those things will play into which one would potentially be the right flavor to fit in with the rest of your benefit package. As far as similarities, where all of the types are the same, as I mentioned before, they always have to be funded by employer contributions. That is always true. They are only available for tax-favored reimbursement of Section 213D qualifying medical expenses. That can be broader or narrower depending on, what type of arrangement and plan design, but that's kind of the broadest that it can be, is just qualifying medical expenses. They can't be cashed out. So if you're making X amount available during the year, and then ultimately that doesn't get utilized for qualifying medical expenses, there isn't any option to cash out the amount that was left over. That gets forfeited unless you've designed your plan with a carryover. And that is permitted by all of these different designs, that unused amounts could carry over into the next plan year, but ultimately just can't be cashed out from one plan year to the next or upon a termination of employment. And they are also all subject to ERISA, and so we'll talk about what that means in just a moment. As far as differences, I already mentioned a few of them before. The type of eligible employers is different. The type of eligible employees and family members can vary from one HRA to the next. The contribution or funding limits that the employer is allowed to make available. Whether or not a spend down provision is permitted. So that's different than a carryover. The spend down would be when an individual loses eligibility for the HRA and they have amounts left over. Could there potentially be a spend down provision where they could continue to submit qualifying medical expenses for reimbursement? So it's not a cash out. They would still have to use it for qualifying medical expenses, but it would be available beyond the end of their eligibility. So that's sometimes permitted. The reimbursable expenses, kind of which portion of qualifying medical expenses is allowed to be reimbursed, will differ. The biggest difference from one HRA to the next is that some of them will allow premium reimbursement, some of them will not, or some of them will only allow reimbursement of certain types of premiums. Depending on how it gets designed, it can impact HSA eligibility and make individuals ineligible to contribute to an HSA. Whether or not it's subject to COBRA requirements can vary. For the most part, all of the plans are subject to COBRA continuation. QSERA, that qualified small employer HRA, is the exception to that. Most of them are subject to PCORI fees as a self-funded plan, but not all of them. And then finally, most of them are subject to some level of non-discrimination requirements, primarily under 105H, because they are self-funded group health plans. Under those rules, we can't favor the highly compensated too much. And under 105H rules, that's the top 25% highest paid. So for example, if you were trying to put an HRA in place where it's made available only to your executive or management staff, or perhaps you give a larger funding amount via the HRA to your management staff and not the rest, that's likely an issue under the 105H non-discrimination rules. As far as administration, when employers are exploring these, we often get the question about whether it can be self-administered. And the answer is potentially yes, but most of the time it's not recommended. If you are doing a very kind of narrow purpose HRA, we're starting to see these be more common around maybe a particular type of expense. I have one example where it could potentially work. We had an employer that had a dental plan that didn't provide coverage for some things that their employees needed, and they weren't able to build that into their dental plan. And so what they decided to do was put in an HRA specifically to reimburse those types of dental expenses. So obviously not going to have a lot of a volume, not a lot of employees that are even going to qualify for that reimbursement. In those cases where you're going to have such a low claims volume, and it's very specific as far as what they would need as far for claims and substantiation to reimburse that. In those cases, it's possible to self-administer. When we're doing anything else, there are a lot of reasons why it's not recommended, and I've got several of them from a compliance standpoint listed here. The first one being HIPAA privacy and security, just having access to more claims data, having to be more careful about who handles that, making sure that it's not used for employment-related purposes outside of just administering the plan. Just one more thing that you'd have to kind of build the right safeguards around and make sure that you're being very careful with. Claims administration, as I mentioned before, these are subject to ERISA. And so making sure, perhaps a little bit more straightforward with HRA claims than it might be for your broader group medical plan, but still making sure that if claims are denied or if there is any dispute over what should have been reimbursed, that ERISA claims and appeals procedures are being followed and timelines are being followed for that. COBRA administration, as I mentioned, most HRAs are subject to COBRA. I'm going to talk about that a little bit more in a moment, but just mentioning here that that's another piece that the employer would have to then self-administer and make sure if individuals end up electing and paying for COBRA beyond losing eligibility, that they'd have to make sure that that continues to be available and have mechanisms in place to manage that. And then finally, just being aware of general compliance requirements. And so as changes affecting HRAs might occur, making sure that the proper notices are going out, making sure that the plan is collecting proper substantiation for reimbursements, doing any necessary reporting and fees that may be required. Those are things that you might still have to do in offering an HRA, but when there's an administrator involved in that, they can help with reminders, they can help pull together the necessary information, and just really assist with those general compliance requirements as well. When we think specifically about ERISA for HRAs, I talked about the claims and appeals procedures already, so I won't mention those again. But the standard things that we think about under ERISA, we would have to think about for our HRAs as well. So it would have to have a plan document, have to have a summary plan description or SPD. A lot of times those might be the same document, which is fine, but then making sure that that SPD gets distributed. It could be plan documentation on its own for the HRA and treat it as a separate ERISA plan. That would be fine. What we see most often is that employers will bundle this in with their other ERISA benefits as part of a wrap document, and that also satisfies the requirement. So either way is fine. That will play into Form 5500 filings. Any ERISA plan is subject to annual Form 5500 filing requirements if there are 100 or more participants. If you've decided to set it up as a separate plan, it has its own plan documentation. You'd look just specifically at the HRA, and if it had 100 or more participants, a Form 5500 would be required for the HRA. If you decide to bundle it in with the rest of your benefits as part of a larger ERISA plan using a wrap document, then you just have one ERISA plan that the HRA is a benefit under, and then we look at, are there 100 or more unique participants in that bundled plan? If yes, then the HRA would just be included. It would be one of the benefits that gets listed on that Form 5500 filing. When we think about COBRA, this is probably one of the places that we see a lot of employers miss, that they don't understand or don't think about that the HRA is subject to federal COBRA continuation. It is a type of group health plan that we have to offer continuation for. Most of the HRAs, I said the qualified small employer HRA is the exception. The rest of them are subject to COBRA. So we do have to offer COBRA continuation when there's a loss of eligibility following, for example, a termination of employment, a reduction in hours, a divorce, for dependents, spouses, and dependents as well. If it's bundled with the medical plan for active employees, then we can do the same thing for COBRA participants. And what that would ultimately mean is when you make that offer of COBRA for the HRA, you could say is you can only elect COBRA for the HRA if you also elect COBRA for the medical plan. That's pretty common that employers will do that. They might even say, or you could elect the medical plan on its own, but you can't elect the HRA alone. That would be okay as well. So if it's bundled, they have the option to do that for COBRA purposes as well. But if it's a standalone HRA, if employees have the option to elect the HRA without the group medical plan, so for example, your accepted benefit HRA, that can often be the case, then it would have to be offered as a standalone option for COBRA continuation purposes as well. You do get to charge a separate COBRA premium specific to the HRA. It's not wrapped into the medical plan premium. It's not, though, tied directly to the annual funding amount that the employer makes available, or even the remaining balance that an individual might have left whenever their coverage terminates. What it's supposed to be built off, similar to how we do it for a self-funded group medical plan, is kind of average utilization, so that it would be the same premium for all individuals who are offered COBRA for the HRA. And I've got an example here to illustrate that. If you have an HRA for single coverage where the employer is making $2,500 available annually, but when you look at average participation, and you can use either an actuarial determination, or you can look at past years and kind of look at average utilization. And what we ultimately find is that most individuals are only using $1,200 of that $2,500 each year. What we would charge for the COBRA premium then would be $102 per month. So we're taking that $1,200 divided by 12 to get the monthly premium, and then adding on that 2% administrative fee. The reality is that most individuals are not going to elect COBRA and pay that monthly premium to get access to the HRA dollars. They're basically paying to get a very similar amount back out, and potentially even a lesser amount, depending on what their balance is when they leave the plan. So it doesn't often make a lot of sense to elect and pay for COBRA premiums on the HRA, but that doesn't change the fact that it really technically is required to be offered by the plan. So that was kind of an overview with the background for HRAs, and then the similarities and differences in some of the key compliance pieces. And now I want to jump into a standard HRA type and talk about the general rules for the standard HRA. When we think about design considerations for these types of general purpose kind of standard HRAs, they can be offered by employers of any size, big or small. They can be offered alongside a fully insured or a self-funded plan. They can be offered to any individuals who are also enrolled in the employer's group medical plan or the medical plan of another employer. So it has to be tied to a group medical plan. The HRA on its own doesn't cover all preventive coverage. It has annual dollar limits that would violate the ACA. But what they've told us is that if we bundle that with a compliant group medical plan, then it's okay. So the way we do that, the way it's required to be bundled, is that we can only offer it to employees and family members who are also enrolled in a group medical plan, either through the same employer or through another employer, maybe the spouse's employer. There isn't any cap on employer funding. There isn't a minimum amount, there isn't a maximum amount, so that's totally up to the employer. It can reimburse any qualifying medical expenses except for individual health premiums. It can't reimburse individual health premiums. It could technically reimburse other group health plan premiums, but we know that most employers allow employees to make pre-tax contributions through the Cafeteria plan, so they can't do that and then also get reimbursement from an HRA. That would be double dipping. So for the most part, these really are not used to reimburse premiums at all. They're really used to reimburse more general qualifying medical expenses, and when it's bundled with the medical plan, often tied to cost sharing under that integrated medical plan. It can be limited further by design. So if you're wanting to make it for a very specific purpose, you can certainly do that. That would really be up to you as the employer. But depending on how you define what's reimbursable, it could potentially cause a loss of HSA eligibility, unless, what you can do there is you can make it post-deductible. We're going to talk about that a little bit more in a moment. But if you wait until the minimum HDHP deductible is met, then you can preserve HSA eligibility as well. When we think about general compliance considerations for our standard HRA, as we've talked about, subject to ERISA, subject to COBRA, subject to PCORI fees. Specifically on PCORI fees, if the HRA is offered alongside a self-funded group health plan, there are special rules that allow them to treat them as a combined plan, and we just pay the PCORI fee on the unique number of participants, and typically it's going to be the same individuals, so you just pay it once. But if that HRA is offered alongside a fully insured plan, then you are required to pay the PCORI fee just specific to the HRA. These are subject to 105H non-discrimination rules, so we do have to be careful in how these are designed so that we're not favoring the highly compensated individuals and then putting the tax benefit at risk for those highly comped participants. These standard HRAs follow kind of all of those rules that I was just talking about, but they can come in different designs. So most often what we're used to seeing is that it's to reduce cost sharing tied to the medical plan, and they're really integrated and administered together. We do have to be careful sometimes, especially for fully insured plans, the carriers won't allow the employer to bundle an HRA alongside it. It just kind of changes behavior, they think, potentially for the plan. But that is pretty common, that especially as we've added higher and higher deductibles, that they'll offer an HRA alongside that to help cover the cost and get their participants closer to having that deductible covered, and then certainly can continue to cover additional cost sharing, co-pays, and co-insurance that would be incurred under the plan beyond that as well. We're starting to see more and more spousal incentive HRAs. So when we're looking at, employers, whether they're wanting to get less participation on their plan from spouses, employees, or maybe they're just trying to give an additional benefit to those employees and spouses who are choosing to waive their plan, one of the things that employers can do, rather than doing some type of a spousal carve out or a spousal surcharge, is they can offer a spousal incentive HRA, where they would say, great, if you're going to waive our plan, we'll give you this HRA instead that you can use. It'll be integrated with the spouse's employer's plan, so we still have that integration met, that you can use then to cover costs toward the deductible and cost sharing that you will have under that other plan. HRA, HSA stacking, where you can set it up in a way that individuals could potentially have the HRA and then still be eligible to contribute to an HSA. And I'll talk about that a little bit more in a moment. And then the final one, and this is as we're getting more and more creative, where employers will do it for a very specific purpose. Maybe it's something that the coverage isn't available to the extent that employees need under the plan. Infertility is a good example of that. Weight loss drugs are another example of that. Sometimes, we're looking to carve out and cover just very specific expenses, specialty drugs. We're seeing some of that, maybe some extra coverage for those with chronic conditions. Those would all be options that you could offer this type of plan to those who are enrolled in your medical plan. And then this would be a supplement to that, but for a very specific purpose. So the main one that I talked about, and I won't spend a lot of time on this one, is that the HRA could cover some or all of the deductible. The one thing I will say, if you can do this administratively where they really are kind of bundled, the administrator is very connected to the claims as they're being processed through your medical plan, is that then it can be pretty seamless for the participant in that it would be run through the medical plan. Any cost sharing that applies then is run through the HRA and covered to the extent that that's available. And then they would only bill the participant with the remainder. So it makes it kind of a nice process for your plan participants. With the HRA HSA stacking, here what you would have to do to preserve HSA eligibility, if it's offered alongside an HDHP, is if you make sure to make that post-deductible, then individuals could still receive employer HSA contributions, or even if that's not available, the employees would be eligible to make HSA contributions. And I've got a quick example of how this would potentially look. It doesn't have to be post-deductible tied to the HDHP plan's deductible. It has to be post-deductible based on the minimum HDHP deductible that's required under IRS rules, which if we use 2026, it's $1,700 for single coverage. So example here, we've got an HDHP with a $3,000 deductible, $7,000 out of pocket paired with a $1,500 HRA. But that HRA, those $1,500, they aren't available until at least $1,700 in claims have been incurred. So what would happen then, you can see as it's stacked on the right, the participant would be responsible for the first $1,700. Now, if they're putting money into an HSA, they could potentially use that for reimbursement. That would be fine, but otherwise they're responsible for the first $1,700. And then when they go from 1,700 to 3,000 to get up to their deductible, that's where the HRA would kick in and cover that $1,300. And then there would still be a little bit left. They'd still have 200 left over that once they hit that deductible and the standard cost sharing kicks in, the additional $200 could go toward any remaining copays or coinsurance. And then they would be responsible, either HSA reimbursement or paying the rest until they hit the full 7,000. I mentioned already a little bit about the spousal incentive HRA. This would be available to those who are waiving your plan and then instead choosing to enroll in a spouse's employer's plan. It could be offered to the employee to get them to waive. It could be offered just to the spouse to get less spouses participating in your plan, or it could be both. You really have a lot of flexibility to decide what type of behavior you're trying to influence. The one thing to be careful of from an administrative standpoint is that you have to make sure that they are truly enrolled in another group health plan, and you don't have that since they're not enrolling in yours. So you would have to have the employee either attest to that enrollment elsewhere, or some employers even take it a step further and will ask the other employer to verify enrollment in the plan. This does a couple different things depending on what your goals are. It potentially encourages employees to waive the employer's plan, makes the employer's cost and exposure more predictable because it's an HRA versus incurring claims and that potentially playing into premiums the following year. It also can be used just as an alternative for those who may already be waiving the employer's plan, but thinking, well, gosh, I'm not even taking advantage of what my employer makes available via benefits. This is just a different way to provide that's a similar package or a similar dollar amount to those employees. Then finally, I do want to mention, because this continues to come up, especially as we have more and more employees 65 and older who are remaining in the workforce, and employers saying, how do we encourage them to move to Medicare, transition from our plan to Medicare? And the reality is you really are not supposed to be doing that. If they voluntarily make the move, that's fine, but you're not supposed to be playing a role in that. And that would include not offering an HRA that would provide Medicare reimbursement. For any employers over 20 employees or more, the Medicare secondary payer rules say we can't incent them to move to Medicare, and certainly offering an HRA or any type of Medicare premium reimbursement would be seen as an incentive. So that would violate Medicare secondary payer rules. The other thing that it is a problem under are the ACA rules. It would create an employer payment plan, similar to how we're not allowed generally to reimburse individual coverage premiums other than via an ICHRA. That can be a problem if it's for 2 or more current employees. So for both of those reasons, we really can't put an HRA in place just specifically to reimburse Medicare premiums, unless you are a very small employer, less than 20 employees, and then meeting certain criteria if you set that up in a certain way. So if you do fall into that bucket, if you're a very small employer and this is of interest to you, this would be a place that you can ask your broker about and have them help you kind of navigate this. But for the general population, this isn't going to be an option. With that, Dan, I think I get to turn it over to you. Are there any questions that we should address before we move on?
Yeah, it looks like there's a couple. There's one about charging the COBRA premium for the HRA, and whether that's required, included. I think it sort of depends on how or who can elect COBRA with the HRA, right? So if the HRA is bundled with major medical, and in order to elect the HRA, you have to elect major medical, then the premiums would typically be bundled as well. But you're not necessarily required to charge a premium for the HRA.
Right. Agreed. All
Um,
right.
yeah,
Um,
I
We did get one question around the HRA HSA stacking that I'll answer, and the question was just administration and how that would get sorted if it's a post deductible. It's really going to depend. Ideally, again, if it's something that's bundled right in with your medical plan, and you have the administrator tied in and has kind of real-time access to those claims, that's going to make it pretty seamless. They're going to be able to run that through and say, hey, here's how much the plan pays. Then they look to see, did they hit the 1700 yet? If the answer is yes, that HRA could kick in. If not, then it would go to the participant. So that can be pretty seamless, and vendors should be able to set that up if you just let them know that you're designing it as post deductible. All right, I will turn it over to you, Dan, to take us through a bunch of different kinds.
Yeah, sounds good. So just to kind of focus in on a few different types of HRAs, Reagan kind of gave a high-level overview of some of these, but just to provide a little bit of detail. First HRA we're going to talk about is a HRA for dental and vision coverage. These are commonly referred to as limited purpose HRAs or limited scope HRAs. These can be offered by employers of any size and offered to employees and their family members. There is no cap on how much the employer can contribute to these HRAs. What does set these apart from your traditional HRA is that they can only reimburse accepted benefits, which generally is going to be limited to dental and vision expenses, hence the name. And I think the primary reason that an employer is going to offer a limited purpose HRA is that these can be combined with DHP HSA coverage, because a limited purpose HRA that reimburses only dental and vision expenses does not have a negative impact on HSA eligibility. In terms of compliance consideration, these are going to be subject to ERISA and COBRA, but will not be subject to the PCORI fee requirements. And then they will be subject to the 105H non-discrimination rules, which again apply to your self-insured medical reimbursement plans. Next up, the accepted benefit HRA or EBHRA. These are non-integrated standalone HRAs that, as the name indicates, qualify as accepted benefits. These act very similar to a general purpose health FSA, with the one exception is that because they are an HRA, they are completely employer funded. There are no employee contributions. These can be offered by employers of any size. And then one thing to keep in mind as we cover the next few HRAs is their ability or inability to be offered alongside a traditional group health plan. To offer an EBHRA, the employer must make other non-accepted, non-account-based group health plan coverage available to the EBHRA participants. Unlike a traditional integrated HRA where enrollment in other group health plan coverage is required in order to participate in the HRA, with an EBHRA, it can be offered to employees who are simply eligible for other group medical coverage. One of the primary differences between a traditional HRA and EBHRA is that for the EBHRA, the employer contribution and funding is capped on an annual basis. As you can see here for 2026, the employer would not be able to contribute more than $2,200. And that is a flat dollar amount that applies on a per employee basis, regardless of how many other individuals' medical expenses can be reimbursed. And it doesn't matter if the employee has self-only or family coverage. Like other HRAs, the EBHRA can reimburse qualifying medical expenses under Code Section 213D, but it cannot reimburse premiums for individual coverage, Medicare, or non-COBRA group health plan coverage. And like other traditional HRAs, there is an expense eligibility and substantiation requirement that does apply. And then lastly, an EBHRA does follow the general guidelines with respect to impact on HSA eligibility. So that just means that unless it were designed as a limited scope or post-deductible HRA, it will negatively impact the participant's HSA eligibility. In terms of compliance considerations, the status as an accepted benefit generally means only that it's not subject to certain healthcare reform mandates and HIPAA rules. It's also not subject to PCORI fees, but it will be subject to ERISA and COBRA absent some specific exception. The EBHRA is subject to 105H non-discrimination. So employers want to make sure they aren't offering a larger benefit to certain highly compensated individuals. The EBHRA is also subject to a specific uniform availability requirement, which provides that the HRA must be made available under the same terms and conditions to all similarly situated employees or individuals. And that definition of similarly situated follows the HIPAA definition, which essentially says that you can offer or make distinctions between groups of employees so long as that distinction is based on bona fide employment-based classifications. So full-time, part-time, date of hire, geographic location, union versus non-union, etc. Some potential use cases. This could be an optional benefit for employees who waive the employer's group medical plan. As I mentioned, it's not required that they have that coverage. And then also for specific reimbursement, for example, weight loss, this can be made available beyond those enrolled in the group medical plan. So moving on to an individual coverage HRA, we get a lot of questions about these. These are certainly gaining popularity, I would say. These can be offered by employers of any size, and we'll talk more about some specific situations where offering an ICHRA can be advantageous. One of the specific requirements for offering an ICHRA is that it's integrated with individual health coverage or Medicare. This means that participation in the ICHRA is limited only to employees who are enrolled in individual coverage or Medicare for each month that they are also covered under the ICHRA. So, for example, an ICHRA would not be available to an employee who is enrolled in their spouse's group medical plan. The ICHRA must implement reasonable procedures to annually substantiate that each participant and the dependent is in fact covered by the or that is covered by the ICHRA is in fact enrolled in that other coverage, individual coverage or Medicare, and that can be done simply by documentation from like the insurance carrier or simply having the participant attest that they have the other coverage. Another design requirement that's unique to ICHRAs is that the employer cannot offer employees a choice between an ICHRA and traditional group health plan coverage. So, for example, if I have 100 employees, I can offer 50 of them the traditional group health plan, and I can offer the other 50 the ICHRA, but I cannot offer all 100 employees the option to choose between the two. One nice thing about the ICHRA is that there are no limits on employer funding. So employers can determine how much they want to spend on an annual basis and then set the reimbursement level accordingly. However, although there is no minimum limit, ALEs or applicable large employers subject to ACA requirements may want to make enough available to ensure the offer of the ICHRA coverage is considered affordable for ACA purposes, and we'll talk about that more. On the other hand, small non-ALEs may want to make the ICHRA unaffordable so that individuals can still get that premium tax credit. If there are any leftover funds and participants don't use them, the employer can keep them or they can design the ICHRA so that certain levels of carryover amounts are available from one year to the next. The regulations do require, with limited exceptions, that the ICHRA must be offered on the same terms and conditions to all employees within a specified class. One exception to that is that contributions can vary by age on a 3-to-1 ratio. So you could offer older employees up to 3 times more, a 3-time greater contribution than you offer to younger employees, or by the number of dependents eligible for reimbursement. Because individual coverage premiums do vary by age, it does sometimes make sense to offer older employees a larger contributions amount, but that's not required. And then one other thing I wanted to highlight is that there are specific class requirements. I think this is one of the things or one of the requirements that's often overlooked when employers and brokers are considering, implementing an ICHRA. If the ICHRA is not offered to all employees, then it can only be offered to employees within predefined classes. And those classes include full-time, part-time, seasonal, salaried versus non-salaried, geographic location, union versus non-union, employees who have satisfied a waiting period, certain non-resident aliens, and then temporary staffing firm employees. So any group of those, any group of employees formed by combining two or more of those groups is permitted. Um, but just to reiterate that the employer cannot design their own classes. Some examples that would not be compliant that we get questions about would be, can we offer an ICHRA only to non-management employees or only to management employees or only to sales and commissioned employees or only to Medicare eligible employees? Those would all be examples that would not be permissible. Also, as is the case with other HRAs, non-employees and individuals who are considered self-employed are not eligible. So that would be like your independent contractors, owners, board members, outside directors. They cannot participate in the ICHRA. ICHRAs can reimburse all qualifying medical expenses under 213D, including individual health premiums and Medicare premiums. As a matter of plan design, the employer could choose to limit reimbursements only to premiums or certain medical expenses. However, reimbursements cannot be limited only to expenses not covered by Medicare. Another thing to consider with reimbursement options is that if the employer does not want the ICHRA to impact HSA eligibility, then, like we've talked about, it has to be limited to those post-deductible expenses or accepted benefit limited purpose. And then finally, as I mentioned, the ICHRA can be used to satisfy ACA requirements for the ALEs. An ICHRA offer of coverage can be considered affordable, and I'll back up for a second. It can be considered minimum essential coverage under subsection A. Um, so if an employer, an ALE offers the ICHRA to full-time employees, they can satisfy their subsection A requirement, which requires offering it to 95% of your full-time employees. And then it can also offer or satisfy the subsection B requirement, which is affordable minimum value. The ICHRA can be designed to be affordable, and if it's considered affordable, it will automatically be considered minimum value. The process for determining affordability is a little bit different than normal traditional group health plan coverage. Generally speaking, affordability looks at the premium for the lowest cost silver plan less the monthly ICHRA reimbursement amount, and then that's going to be your employee contribution, which then you would run through the normal safe harbors to determine whether it's affordable or not. And then one other brief design consideration I do want to mention that we have seen questions about is that employers cannot offer employees a choice between electing an ICHRA and taking additional compensation. So that would not be permitted. A few compliance considerations. Like most HRAs, it's going to be subject to ICHRA, COBRA, and PCORI fees. We get quite a few questions regarding ICHRAs and COBRA. An ICHRA is a group health plan subject to COBRA continuation. An individual who loses eligibility for an ICHRA due to a qualifying event like termination of employment needs to be offered COBRA for the ICHRA. One exception is that if the individual does not maintain their individual coverage, then that would not be a qualifying event. One common scenario that we get a lot is employers who are moving from traditional group health plan coverage to an ICHRA. Anyone who is already on COBRA under the traditional group health plan would then need to be offered COBRA under the ICHRA. And doesn't always make that individual happy, but the employer is obligated to offer COBRA under the ICHRA. As a practical matter, although COBRA has to be offered, it's rarely going to be an attractive option for the individual to elect because they can be required to pay as Reagan talked about, 102% of the premium, and that essentially cancels out any benefit they would receive under the ICHRA anyways. So most likely, people aren't going to be electing COBRA with the ICHRA. And then like other HRAs, the ICHRA can be subject to 105H non-discrimination rules if it can reimburse more than just premiums. And then lastly, it's also subject to ACA reporting. I talked about affordability and subsection A and B, but you are required to do that 1095 reporting for an ICHRA, just like you would self-funded traditional group health plans. Just to touch on a few potential situations where ICHRAs may be advantageous. Small employers and those who have trouble meeting participation requirements imposed by carriers can offer ICHRAs. Employers with high claim rates um, could potentially see a decrease in healthcare spend by moving at least a portion of their population to an ICHRA. It can also be an attractive option for part-time employees. I know it's not super common that employers offer benefits to part-time employees, but the employer could choose to offer at least a relatively small employer contribution, which could be an attractive benefit. It could be an attractive option if the employer has a spread across the country, let's say, and has employees that are in different states. One of those specifically permitted classes I mentioned is geographic location, so they could choose to offer an ICHRA to, let's say, all their Minnesota employees and then offer a traditional group health plan to all their Wisconsin employees. One thing I do want to mention kind of along those lines is there are minimum class size requirements that apply. For example, if an employer has fewer than 100 employees and offers a traditional group health plan to some of the employees, then to offer the ICHRA to another group, there has to be a minimum of 10 employees eligible for the ICHRA. So minimum class size requirements is something that needs to be considered. I already mentioned ALEs who want to satisfy their ACA requirements. ICHRA is certainly an option. And then lastly, although the ICHRA cannot be offered to just Medicare eligible employees, if an employer has a significant number of employees who are Medicare eligible, they may be able to design the ICHRA so that it's an attractive option if they can figure out an allowable class. Qualified small employer HRA, these are pretty uncommon. Um, as the name indicates, they're available only for small employers under 50 full-time employees who are so non-ALEs. Um, I suspect one of the reasons is that they aren't common is that you cannot offer this and also offer a traditional group health plan. Um, and that would include employers within the same control group as well. For employers who do offer the small employer HRAs, it must be made available to all non-excludable employees. In other words, employers can only exclude certain permitted groups. Those somewhat follow kind of the ICHRA class rules. Former employees, retirees, and owners would not be eligible to participate in a small employer HRA. For reimbursement to be available, each individual whose expenses can be reimbursed must be enrolled in minimum essential, group health plan, individual, or Medicare coverage, and they have to provide proof of that. Unlike ICHRAs and other HRAs, employer funding is capped at a specific amount. You can see those 2026 amounts there. But similar to an ICHRA, the small employer HRA can reimburse qualifying medical expenses, including premiums. It can even reimburse premium payments for coverage for a spouse or other family member. And then lastly, the small employer HRA will impact HSA eligibility unless limited to certain expenses, as I've mentioned before. Just a quick run through these. Again, it is subject to ERISA. It is not subject to COBRA. So that can make for an attractive option for those employers between 20 and 50 who would otherwise be subject to federal COBRA. This could be an attractive option. It is subject to PCORI fees, and it is not subject to ACA reporting. And then just the last HRA I wanted to touch on. This one is relatively common. This is going to be your retiree HRA. We get a lot of questions about compliant ways to provide benefits to retirees. And there are, of course, several options of doing that. You can extend your traditional group health plan coverage. You could subsidize COBRA. But one of the more flexible options is going to be a retiree HRA. To remain compliant as a standalone HRA and avoid certain healthcare reform requirements, it can only be offered to retirees and not active employees. So you'll often see this referred to as a retiree-only HRA. Like most HRAs, there is no cap on employer funding, so employers can limit their financial exposure regarding the retirees through plan design. It can reimburse all qualifying medical expenses. It can reimburse COBRA premiums, individual health premiums, group health plan premiums under a separate plan, for example, through a spouse. and Medicare premiums. The employer can also design it to reimburse only specified expenses as well. It will impact HSA eligibility unless limited in scope. Compliance considerations, retiree HRAs are subject to ERISA, COBRA, PCORI fees, and 105H. One feature with the retiree HRA is that it could be offered as an alternative to COBRA. So you could give retirees a choice between the retiree-only HRA and COBRA, or you could offer it in addition to COBRA. But either way, the retiree HRA itself would be subject to COBRA. So if you had a situation where a spouse or dependent lost coverage for the HRA due to a retiree's death or divorce, they would need to be offered COBRA under the HRA. It is subject to ACA reporting, so that would include both the year the employee retires and then subsequent years that they are provided coverage. And then lastly, just a few strategic considerations. As I mentioned, it can help employers budget for exact exposure when it comes to retirees. And then it's also super flexible in terms of what types of reimbursements it can provide. So I think that's it. Looks like we give a couple questions.
I did have one, Dan, you kind of mentioned it briefly, but we didn't talk about it a lot, for owners. I know that owners, a lot of times employers will include them as eligible and allow them to participate in different employer sponsored benefits, which is okay, but they can't participate on the same tax favored basis. So if they're not common law employees, the HRA isn't going to be an option for them, at least not on a tax favored basis. They won't let the owners won't be able to submit their qualifying medical expenses and then get reimbursement on a tax favored basis. It would be possible to allow them to participate on an after tax basis, and maybe the employer just reimburses those expenses, but then includes it in the owner's taxable compensation. But for that reason, it's not an attractive solution for them the same way that it is for employees. But with that, I think we covered most of the comments and questions that came through. So I think we'll turn it back over to you, Jenny.
Thank you both. Covered a lot of great content today. Thanks to our audience for tuning in. If you did have any further questions or want to discuss anything further, please do reach out to that benefits advisor who invited you here today. They'll certainly be able to help you out. And again, thank you to those benefits advisors and consultants who are partners of AssureXglobal for making today's webinar possible. And those are also the folks that you could reach out to if you would like to receive a copy of the recording of today's presentation. But with that, that does conclude our webinar. Wishing you all a happy Thanksgiving next week. Hopefully everyone's able to enjoy some time off. And thanks again for joining us today. Have a great afternoon.